And welcome. I'm Aaron Putsey. I'm with the Iowa Soybean Association. I serve as the Senior Director of Information and Education. I'd like to welcome you to today's webinar, Soybean Economics 2022, Production, Pricing, and Planning, and it's powered by the Iowa Soybean Association and the Soybean Checkoff. The Iowa Soybean Association is driven to deliver insights, tools, and activities that improve the competitiveness and profitability of Iowa's 37,000 soybean farmers. Today's webinar is an example of this commitment of how we are driven to deliver. I'm confident that you'll benefit from our timely discussion today of issues impacting soybean prices, production, and profitability. Our guests today include Rob Ewalt. Rob serves as president of the Iowa Soybean Association. Also, Mac Marshall, Senior VP of Market and Intelligence for the United Soybean Board. Our time together is going to be divided into three parts. We'll have a welcome by Rob. We'll then have insights provided by Mac, and then we'll follow by questions from you, the audience. So we just encourage you throughout the webinar here this morning, please use the chat function or the message function there to submit questions that you have, and we'll be sure to make time at the end of Mac's conclusion of his comments to answer the questions that you have. So let's get started. I'll turn it over to Rob Ewalt. Rob is president of the Iowa Soybean Association. Rob?
Thank you, Aaron. Welcome to everybody. This is kind of an exciting time. I farm over here in eastern Iowa, right west of Davenport and 4 miles north of the Mississippi. So everybody get their map out and you'll see right where we're at. Diversified operation over here. We have hogs, we have cattle, corn, and soybeans. You know, when I was asked to give some brief comments about the importance of this Zoom meeting today, the one thing that came into my mind is sometimes we get to have interns come out from colleges in the spring. And the first thing I have them start out doing is we tear down a planter and then we put it back together, because I told them, I said, that's the most important piece of equipment we have on this farm. If we don't plant the seed right, the rest is a moot point. But then after that, then I take them to a marketing meeting with some of my grain buyers. And if we don't sell it right, we don't make money, we don't stay in business. And it's that simple. And, you know, with the way the soybean industry has been as of late, you know, we had some not so profitable times the last few years. And now all of a sudden, look at what we're doing. We see some big yields all around the state, and we still see big prices, which is great. And we need to understand a little bit more what's happening. There's a lot of stuff happening with the oil part of the soybean complex, and then that brings up other questions. Well, what do we do with some protein, and what's this look like going down the road? And I think that's why, you know, some on the board brought up an idea of, you know, we have a great asset here at the United Soybean Board with Mac Marshall, and why don't we utilize it? You know, so here is a great opportunity. It's kind of I think this is one of the first ones done, and see how it goes. But I want everybody that's on here to realize that we've already paid for this with our checkoff dollars. You know, that's the great thing about this, is that these are your dollars being used, and this is how it's going to help you on your farm. And so that's why we invited Mac Marshall, the Vice President of Market Intelligence for the United Soybean Board and for the U.S. Soybean Export Council, to help us understand the dynamics heading into 2022 and probably further, I'm guessing, right, Mac? And Mac works with USB and USEC leadership to evaluate and establish long-term strategic initiatives in support of advancing domestic and international market opportunities for the U.S. Soybean Association. He also serves as an industry source of market information and analysis. Prior to joining the USB and USEC, Mac served as global market analysis and trade lead at Bear Crop Science, where he worked on international market access issues as part of global ag policy team. Mac, thank you for joining us today. A reminder to all the attendees to use the question and answer feature to ask your questions, and we'll have Mac take questions after the presentation, and let Marketing with Mac begin.
Well, fantastic, and good morning, everyone. Thank you very much for the kind introduction, Rob, and thank you, Aaron, and thank you, Iowa Soy. It's a real pleasure to be here this morning and to get to talk with all of you. And I'd be remiss if I didn't point out a special thank you to April Hemis, who serves on the USB board as well, who initially approached me with this idea a couple weeks back. So I think in the true pioneer spirit of Iowa, this is the first instance in which we're doing this and having kind of a direct, Q&A open forum talking markets with one of the state boards, and I'm thrilled to do it. So I think as Rob mentioned here, so I actually serve across two organizations, first with USB and with USEC. One obviously focused on our long range strategy, working with the other strategic VPs at USB. And then of course, with our international wing, our USEC in terms of international market development, because we have a great domestic disappearance channel. Certainly, Iowa, #1 in the country in hogs, one of our biggest customers domestically. But, we still have the, critical importance of moving beans, meal, and oil around the globe to ensure that we're, bringing enough value back. So, that partnership with USEC is also very, very critical. Just a couple things I wanted to tee off with here. So, one, as Rob said, one of the first things that he does when, introducing new interns to the ag space is, have that marketing meeting. One thing I'll say that I am not a grain marketer. I'm not a merchandiser. I'm not providing hedging advice. Really, this is meant, I think as he had said, this is really meant to be an informational session where, you can ask me questions about things that are unfolding in the markets, international dynamics, everything that's relevant and pertains, back to, what your operations look like and really what soy markets, how they're unfolding now and in the months and years to come. Really, it's just kind of meant to augment the overall knowledge base so that, maybe when you are having those marketing discussions, there's a little bit extra context behind it. And two, I'm an economist by training and trade, which I think is a bit of a gift and a curse, because typically that means lots of slides and eye charts and stuff that can look more or less like a Rorschach test with a bunch of lines. That's not what I want to do today. I want to keep this conversational. I'm not using slides, so we'll keep it that way. So with that, I think I'd like to do a little bit of stage setting for where we are, as we're roughly 2.5 months into the new marketing year for 21/22, kind of where we've been this last year and what looks ahead. So I think if we rewind about 1.5 years or 1 year and 2 months to the start of the last marketing year, we were coming into that obviously in a much more difficult position in terms of price. Prices were languishing under $10 a bushel. We were still, in a multi-year, I think, swoon in prices. A lot of that instigated by the trade dispute with China. But last year really served as an inflection point for changing things. And I think there were two really pivotal positive disruptions that were unfolding. One, we had China come back as a buyer in a very, very large way. Recall the phase 1 trade deal with China was entered into force on Valentine's Day 2020. And with that, obviously, that was past the peak of our export window for the 19-20 marketing year. So once we hit the ground in September 2020, we really got off to a great start with exports. There was, of course, a lot of beans in captive storage that we were able to move and really get a good jump on that. So that helped bring down expected inventories and see a lot more appreciation in price month after each passing month. And that's what I think was really unfolding in that September through of 2020. And then as we turn the calendar year to 2021, even as our export window was kind of tailing off, as is kind of the customary seasonal element of it, that's when I think we really started to have this new wave come in. And I've done a couple things, I think, with Iowa as well, just talking about renewable diesel and the implications that has for soybean markets. And that's really, I think, the major disruptor that's unfolding right now. So if we rewind to January 2021, that's when we started to have this new wave of announcements of plant capacity expansion around the country, a lot of it on the West Coast, some of it in the Gulf, really kind of oriented towards coastal channels and really meant to serve the California market. Because a lot of the push behind renewable diesel is underpinned by the California Low Carbon Fuel Standard, which is certainly substantially increasing the market for bio-based energy and new solutions. Now, long term, I think as many of you all know, traditional fatty acid methyl ester biodiesel has been a tremendous demand source and been great for Iowa. And now we're moving into this next wave here. So as in January, really the first quarter of the year, we had a lot of announcements coming out by not just by companies that are in the renewable energy space, but also announcements of retrofits and new deals being made by some of our non-traditional players who are more in the petroleum space. We had Chevron and Bunge enter into a joint venture around crush and being able to offtake the oil there. We had Shell Rock, of course, in Iowa, teaming up. I always forget if it's Marathon or Phillips 66, but that allowed for additional offtake of the oil. So as we had this real wave come in, we've seen this fundamental upending of that relationship between oil and meal in terms of value, and really what the value driver of the soy complex is. So if we compare where we are now versus January, we've got soybean oil prices up close to 40%. Meal prices have rallied in the last couple of weeks, but still are down double digit in percentage terms relative to the start of the year. And this is really a fundamental shift. Historically, long term, if you look at the enterprise contribution to crush value, meal has naturally been the driver. Of course, as you crush soybeans, roughly 80% of it goes into meal, less than 20% goes into oil. So it's about a 4-to-1 on a volume basis. So meal has traditionally carried about 60, 2/3 to 70% of the total value. Now, I think as we're seeing this really aggressive bidding from the energy space, just trying to get soybean oil as a feedstock in to run these some of the existing facilities, but also secured for some of the future facilities, that has driven up that price of oil. And now, as many crushers are crushing predominantly for oil, we've seen that meal get cheaper. So that's the aforementioned 40% increase in bean oil prices and double-digit declines in meal. So it's a fundamental divergence that I think the industry is still working through and shaking through and kind of figuring out what is going to be the primary driver going forward. So that's really kind of where we are now. Now, of course, this year, planting and everything, I don't need to tell all of you this, but we've, collectively, I think, had a very good year across the country, despite pretty substantial drought across many, or certainly across the Dakotas, into Minnesota, and certainly into northern Iowa. I remember, talking with a couple of our board members over the summer, we're in different parts of Iowa, and the conditions, were very, very different in terms of rainfall and crop progress. But in aggregate, across the country, at least where we stand now with the present USDA estimates, we are looking at, very, very close to a record-sized crop, really fractionally behind the 2018 crop. And, typically when you have a crop of that size, it winds up being somewhat burdensome for price. But fortunately, that's not been the case. Part of that is because we've really had oil driving the complex and kind of pulling that up. That continued demand from the biofuel space remains there. But we're also structurally in a position right now, at least for this season, where there are shortages in many of the other vegetable oils that are traded globally on a commodity basis. And what I mean by that is, in the Black Sea, there were shortages on production there, which led to some export restrictions. So taking some of the oil that would come out from sunflower seed out of the international market. Canada, of course, was severely hampered by the severe weather that we had over the summer in terms of heat stress and overall just dryness, which did not allow for the canola crop to cultivate well. Talk to growers in the Dakotas who are kind of in that same agronomic zone, and that was a really tough year for many of them. So the Canadian canola crop very short crop this year. And then, the largest globally traded veg oil is, of course, palm oil, with 80+% of that production concentrated in Southeast Asia and Malaysia and Indonesia. Well, it's been on a decline for 2 years in terms of production, which is really attributable in large part to COVID. Now, in Malaysia, which is the second largest producer behind Indonesia, much of the workforce that is needed to harvest palm plantations comes from the Indian subcontinent. So it's foreign workforce coming in, but Malaysia has adopted, really severe restrictions on movement through COVID. So, kind of shuttering borders for many foreign workers. So that's really, kind of hampered the palm industry there for being able to harvest. So all of this together, you look at the whole veg oil complex as a whole between soy, palm, canola, and sunflower. And, we've seen, typically you see production on a global basis increase year after year after year, barring a drought or something like that. Well, we've had kind of this perfect storm that has led to this run up in vegetable oil prices. So I bring all this up, really so we can look around the corner at the next couple of years and what that means. Well, let's start domestically here on the renewable diesel side. If you look at what the Energy Information Administration, has been projecting, we can see this renewable diesel market grow from being about a 1 billion gallon market now to about 5 billion gallons really within the next 3 years. I think this is a faster pace than most anybody would have anticipated. Now, is it really going to grow at that faster rate? Well, that's contingent on a substantial percentage of all of these, new build announcements or retrofits or expansions coming to fruition. And, I having talked with others in the industry, are trying to, relatively handicap how much of that production gets built out. General consensus is, okay, maybe 50% of those new plants or that new plant capacity gets built, but that's still taking it up from being, a 1 billion gallon market to potentially, 3.5 billion gallon market, which is substantial. When you look at renewable diesel and the feedstock needed to produce it, it's, roughly 7.5 to 8 pounds per gallon. So, you look at that, and if it's a 5 billion gallon market in 2024, that's needing 40 billion pounds of feedstock. If it's a 3 billion gallon market, you're needing roughly 24 billion pounds of feedstock. And here in the US, we produce about 26 billion pounds of soybean oil. So, for soybean oil to be the sole supplier, which is not what we expect, there are other feedstocks certainly that, have approved pathways and can flow in to be used as inputs in renewable diesel production. It is necessitating somewhat of a shift in how we're utilizing oil across the whole balance sheet. What we've seen this year is a pretty sharp drop off in soybean oil exports. So for the last marketing year, I think we were down 40% in oil volume exports relative to the prior year. We're about 2 months in, or nearly 2 months into the marketing year for oil and meal. Hold on a second. Jack, I'm on a call. Can you shut these doors? Both of these doors, please. Thank you. Sorry about that. I think we're all used to Zoom calls and, having kids and pets run in. So here we go. No.
Hi.
No, go. Anyway, I hope you all found that cuter than I did. Anyway, so we're basically 2 months into this new marketing year. Our soybean oil exports are down 60% relative to the prior year and well below our 5-year average. And that's because, it's not due to any sort of, demand pullback, and certainly not demand pullback domestically. In fact, that's where we're seeing the surge, and kind of the first, tier of that redistribution is coming out of those export channels. So we're keeping it here stateside. Now, as we think about the global veg oil complex, and there was an announcement earlier today, and if you look at the USDA balance sheets, we're expected to see a rebound in total veg oil production next year, as maybe some of those COVID restrictions come off, as there's some improvement in the tree cycle in Southeast Asia, and of course, as you all have grown close to a record crop, but also as Brazil brings more area into production and is looking to produce a record crop this year as well. So with all of that, we can probably see a rebound in the total oil volume on a global basis. And we'll see what sort of impact that has on oil price. Right now, oil prices are somewhat dictated by carbon credits that are flowing through the low carbon fuel standard that allows petroleum refiners and others in the energy space to bid for it. But we could see a structural retreat in oil prices in these coming years as global production comes back online. And I bring this up because right now, as oil is leading the complex, this is something to watch out for. Now, with oil really leading the complex, being the driver of crush, we've also seen in the last few months, I think many of you are aware of this, we've seen a pretty, I'll put it this way. When earlier in the year, there were all these announcements about renewable diesel facilities coming online, we're trying to, game how many or how much of that capacity is actually going to get built. I'll be honest, to me, it seems a little bit esoteric at that point in time. But what's made it more real for me is the fact that we're seeing, significant capital investment, by private industry in the months since then. And what I'm referring to is, a number of announcements of expanded crush capacity in the U.S. Because for us to actually meet or come closer to meeting what that domestic demand is on the oil side, we have to debottleneck, the system and bring more crush online. So we've had announcements from a number of the large players as well as some co-ops that would basically by 2024 bring up our crush capacity in the U.S. by close to 20%. I think this is a very, very welcome set of developments. Certainly, as we as we look domestically, anything that we can do to mitigate buyer risk and ensure that you've got the offtake channels for your soybeans here domestically, having more crush plants is great. Now, where they're located is obviously going to be different state by state in terms of who benefits from it. But I think as a whole, that's good to ensure that we have that channel, and that channel for purchasing beans gets larger. Now, what this also means is that as we're crushing more, particularly if oil continues to be the dominant driver for crush, now we're faced with the disruption of, okay, well, now we're producing more meal. And I mentioned earlier how meal prices have come down, over 10% since the start of the year, and that's even accounting with the recent rally in the past couple of weeks. Now we have to think about how are we going to, move that meal. And I think, for Iowa in particular, you're in a great position because obviously you have, number one in the country in hog production. So you've got this great disappearance channel that's already there. And I think, hogs here in the U.S., we've lost, soybean meal has lost share, I think, over the last, 20, 30 years as, synthetic amino acids have come online. So I think we're at an interesting point right now where there's an opportunity to potentially regain some of that share, not just as meal is cheaper, but also as synthetic amino acids, maybe coming over from China, and, there are things like lysine shortages. As those are unfolding, that the cost competitiveness of meal, I think, comes up and probably provides some relief for livestock producers, particularly in the swine and poultry space. There's probably an opportunity for regaining back some of that inclusion share in the coming seasons. So I think that's a critical piece here where maybe we can utilize more of that meal domestically. Now, of course, with that crush expansion, there's will be a lot more meal. Yes, domestic offtake is one channel, but we also have to look internationally. And I think a lot of the markets that we'd be targeting there on the meal side, and this is part of where I work with USEC a lot, we've got a great, I think, competitive advantage for meal preference throughout Latin America. These are a lot of markets where, in Central America and some parts of Northern South America, particularly Ecuador and Peru, Colombia to a lesser extent. Actually, Colombia is a pretty big buyer. But all of these are markets that I think have a pretty pronounced preference for U.S. origin soybean meal to flow into their domestic animal and aquaculture. Ecuador has been a huge growth market over the last, really 10 years. Now it consumes, nearly 500,000 tons of our soybean meal. The industry there is growing as an aquaculture producer of high value species that are looking for higher inclusion of soybean meal. So I think there's a lot of great opportunities there as well. Now I think turning or zooming back out a little bit and looking internationally. So let's start to look at our biggest buyer and our biggest competitor. So our biggest buyer is, of course, China. Even in the deepest throes of the trade war, China was still, a large buyer of U.S. soy, although not nearly at the same volumes that we've seen in the pre-trade war levels. But it rebounded pretty significantly this last year. We exported about 35.5 million tons to China. Not a record. In fact, even as we set an aggregate volume record for exports of nearly 62 million tons, shattering the prior record of 59 million tons from marketing year 16-17, none of our top 10 markets actually experienced a record import volume from the US, which I think is notable because it means that our overall strategy of market diversification and looking globally and not just putting all our eggs in one basket, even though China is far and away our largest buyer. I think as we look at those more diversified markets, and part of that I think was really necessitated by the trade war that we had in 2018 and 2019. We're starting to see the benefits of that pay off, where we are exporting to more countries, and we're exporting more volume to different countries that have been able to gain an increased preference for U.S. soy. Now, China is, of course, continuing to struggle with African swine fever, although depending on if you're reading something that's come out of the Chinese Ministry of Ag, which typically paints a rosier picture, or if you're looking at some of the data that's coming out and trying to triangulate it. I'd say the rebound is continuing, and if I think back to 2017, 2018, and the expectation of, oh, this is really disruptive, this could be a 5, 10, 15 year recovery period. And that's what I try to anchor myself to, is that I think this recovery in China has happened faster than any of us would have expected at that point in time. Now, we want the pig herd there, I think, to rebound pretty significantly as a channel, of course, for soybean meal. But in the interim, we've seen Chinese imports of U.S. pork creep up, which is, of course, great for our nation's pork producers, of course, many of whom call Iowa home. This next year, the expectation is for Chinese, pork imports to tail off pretty appreciably, I think, as that herd rebuild continues. So it's kind of a mixed bag when you consider the whole protein complex between, soy meal, and animal protein. But with that, it probably presents a little bit better opportunity for whole bean exports. Now, over the summer, China has had a lot of issues with their crush margins, which disincentivized a lot of purchasing. Of course, that was during the window in which Brazil really is the chief exporter to the world. So it wasn't as impactful for us, but the impact was felt at times when we would see, kind of short 2-3 day dips in soybean prices that would be attributable to, weak Chinese demand for Brazilian soy because of tight margins. Those margins in China tend to be very volatile. They can turn negative very quickly, and they can turn positive very quickly. But I think we've seen a bit of resurgence in the past couple of weeks, which has been somewhat reflected in our export data. The last couple of weeks, we've had really tremendous volume sales and exports to China. We're still well behind last year's pace, but as I said earlier, last year was setting a record. And I think anytime you're measuring against a record figure, be it a record high or a record low, it skews the comparison somewhat. But I'd say our export pace, both to China and the world, has normalized somewhat since the first month. Now, recall the first month of this marketing year, starting on September 1st, there are two factors at play which are really limiting our exports. One, we entered this season following a season of tremendous foreign demand for U.S. soy and a record level of crush. So we came from this position entering the 1920 season of very, very oversupplied. Entering the 2021 season where we had this temporary glut of beans in the U.S. and that was kind of hampering prices for a while. And then as we saw export demand creep up, really, really strong crush predicated by strong margins here in the U.S., when it came around time for September 1st, 2021, we simply didn't have that many captive beans in storage to, that were ready to hit barges and tows and go down the Gulf. And neither was the Gulf ready for it anyway, too, because we had the impact of Hurricane Ida in late August, which really limited loading facilities throughout the Gulf. First couple weeks there, we were well behind, last year's export pace, well behind what we would typically be doing. But with, the surge in export volumes these past couple weeks, including, I think 2 weeks ago, we exported 3.7 million tons, which, as I've looked back as far as 1999, I've not seen a week of export shipments that strong on record. So that's really encouraging, and I think has helped normalize our pace and get us back close. Yes, we're still behind last year's pace, but we're basically in line with the 5-year average of what our exports are. So that program overall, I think, looks strong. I don't think we're going to export as many beans as we did last year. Part of that is, I think, due to some timing, and I'll get to that in a second. And I think part of that is, attributable to the fact that we're seeing more beans consumed here domestically, which I don't think any of us can look at as a bad thing. So now, in terms of timing, this is where I want to turn our eyes to the south, specifically to Brazil. Now, again, I'll provide a little bit of a retrospective from last year, I think, for context that we can glean from for this year. So last year, this time, maybe in October of last year, Brazil was really experiencing, some pretty wet weather due to La Nina, which was impeding its planting pace. It was coming in from a significantly slowed down planting pace. I think, record low, certainly well below the 5-year average and what you would typically expect for the pace there. So what that did is it delayed harvest, it delayed planting of a second corn crop, and it delayed the start of Brazil's peak export window. Brazil typically exports a couple million tons of soybeans in January. That's really when their export season picks up. Last year was 80,000 tons, just for point of comparison. This year, Brazil is actually off to a record pace for planting. As of yesterday, I believe, 86% of the soybean crop had been planted. And, if you follow the logic from last year, where we said, okay, Brazil's very slow on their planting pace here. It's going to delay harvest. It's going to eat into their export window. It's going to eat into their exports. Maybe we can expand our export window as a result of that. And also we'll see some, shortfalls in production. Well, we didn't see the shortfall in production. Brazil still produced a record volume of soybeans, 136, 137 million metric tons this last year. And then with overall strong pricing, a continued weak real, which has only gotten weaker since last year, Brazil has been incentivized to plant even more beans this year. They'll be planting probably over 40 million hectares. It's basically close to 100 million acres. And, early expectations from, market observers down there is that it's going to be a crop that will be a record, over 146 million tons. I've seen some estimates to put it over 150 million. By comparison, we're producing 120 million. So I think when we look ahead to the spring, when you all are making kind of your final planting decisions around rotations and everything, and maybe some of those marginal acres deciding if it's going to be corn or beans, there's a lot of fluid dynamics that are going on right now. So one, Brazil, should be expected to have a very, very large crop. Right now, our beans are, competitively priced relative to Brazil. You do see some convergence on those U.S. origin versus Brazilian origin prices when we get into like the March period, which is kind of a standard seasonal impact there. But I think the other thing too is because we have to really consider corn soy as a system. That by having this aggressive planting pace for beans, when Brazil comes in with their second corn crop, it got delayed last year. They had a very, very bad crop. That was where the impact was felt from La Nina. We're probably not going to see something like that this year. The corn crop's going to go in the ground likely at a well-timed pace. So we could see, by extension, some expectations of a good corn crop out of Brazil as well, which is naturally going to be, weighing on prices. So I think these are some of the major dynamics to look at as, you all are going through positioning season, purchasing inputs, and looking ahead towards planting decisions for 2022. Now, the last thing I'll bring up, and it's a bit of a sour spot, I think, for anybody involved in agriculture right now, but you all, first and foremost, among anyone, is where we are with fertilizer prices. I don't think I need to belabor the point when I underscore that the pressure that we're seeing on fertilizer prices is really quite substantial, and it's attributable to a couple reasons. You've had export restrictions, if not bans, coming out of Russia and China, which are critical raw material producers for fertilizer. When we had Hurricane Ida hit the Gulf, that disrupted a couple production facilities. CF Industries, I think their plant was down for a little bit, and they've had to run it back at higher capacity. Certainly, anyone purchasing Roundup or generic glyphosate for crop protection, the Luling plant owned by Bayer Crop Science was down for a little bit, and they're running, I believe, at full capacity now to try to make up for it, but it's still not, it's still been pretty disruptive. So you put those things together along with, fuel price increases and everything, and even though we're seeing this time now of better prices, certainly this year and last year relative to the 5 years before that, margins are going to come under, I think, pretty severe pressure this year due to input costs. And I know I'm preaching to the choir when I say that, but that should, I believe, factor into some of those, last minute marginal acre decisions. So with that, I want this to be conversational and open. Hopefully you just kind of enjoyed the recap of what's going on here and some of the things that I'm looking forward or looking at for this next year. And with that, I'd love to take any questions and answers and just kind of keep this open forum going. So we'll open it up there. Thank you.
Great, thank you, Mac. And we do have some questions that have come on in during your opening comments and your overview there. And what I may do is I may just kick it over to Rob. Rob, I know Mac did touch on a number of issues as it relates from the present to potentially the future, but I know you probably have a question to tee up, and we've got a couple that are coming through the QA function too. But Rob, I'll let you ask the first question here this morning.
Geez, you threw me under the bus here, because halfway through when Mac was waving off, probably the 3-year-old, I had 2 boys in my kitchen that were fighting. So So
first off, I wish that one was the 3-year-old. That was the 9-year-old. I'll be talking with him later.
No, I mean, you touched on a lot there with, especially when we get back to, our cost of production for the 2022 season and what that's going to do to us. I guess the one question I have, and it is when we do get these crush facilities up and going and start using more domestically on the oil side, I don't think our livestock industry can compete and grow at that same pace to utilize all of that protein. So then you see a market shift from whole bean to bean meal as far as an export. I think maybe I'm wrong, but I try to take the simple approach. And so where does that go in 2 or 3 years down the road? What do we do with it?
It's a great question, and that's how we view it as well. And actually, we're having strategic meetings with USEC about this because, historically, we've been oriented towards, a cohesive international marketing program that's looking at beans, meal, and oil collectively. But of course, on a volume basis, we're moving more whole beans than anything else. This is a little bit more of a shift, as the game is not about moving as many whole beans overseas now. We need to hold some back, certainly, that are going to flow through these crush facilities, de-risk them, make sure they're running through it, and of course, de-risk, our farmers selling off beans domestically. But I think you hit the nail on the head in terms of this shift towards a more aggressive international meal marketing approach, because it's not all going to get hoovered up domestically. So if I look at our markets there, and I mentioned a number in Latin America, where I think will be a pivotal center, but Southeast Asia also matters a lot too. Indonesia is a large whole bean importer, but they're also well set up to receive soybean meal as well, and I think we've done a lot towards gearing preference there. I can go to the kind of the familiar refrain of population and income growth, but if we look at markets where both of those factors are at play, and there's a lot of opportunity, particularly in poultry expansion. Of course, Indonesia is not really a hog producer at all, being a Muslim country. That's a market that has, I think, a lot of opportunity for volume expansion. One other market, which is typically our largest meal importer, is the Philippines. And the last 2 years, and it's off to a slow start this year in terms of their volume purchases, although they did have, I think, a pretty nice, new purchase this last week. The Philippines, much like China, has really been plagued by African swine fever. You're still seeing outbreaks. There's some talks of vaccines getting distributed. So, and we'll see the efficacy of those. I'm skeptical about some of the veterinary vaccines have been, moved around because some of the, faulty ones in China that were not regulated, but was part of why we had some renewed outbreaks earlier this year in China. So all that I think those negative caveats aside, the Philippines, it's a market that consumes a lot of pork. I'd say it continues to be on the dietary evolution upward. And I think right now, with everything that they've been experiencing with ASF and kind of cutting into their hog herd size, that's a market that has not been performing at its fullest potential. I think once we see ASF get under better control there, we'll start to see meal exports rebound substantially there. So I think that's one piece. Right now, we're running into the headwind of ASF from a meal standpoint. I think some of that will alleviate. The other market I'd like to call out in Southeast Asia is Vietnam, which is of course also a large whole bean importer, and they have crush facilities too. But it also serves, I think, as a transshipment point to other parts in the region. And there's also a pretty strong preference for U.S. origin soy meal there. I mean, Argentina does export a lot there, so there's probably an opportunity for us to gain some share from Argentina, particularly as our meal gets more competitively priced, because we have that oil dynamic that isn't necessarily present in Argentina. Actually, on that front, Argentina did roll back its biofuels blending mandate earlier this year from 10% to 5% for biodiesel. So I think that the dynamics that are unfolding there in terms of relative valuation between oil and meal, lead to their meal potentially not being as competitively priced as ours. That can change any day in a spot market, but I'd say structurally, you put all those dynamics together, I think we have opportunities for additional volume movement, not just through price competitiveness, but I think also demonstrating the intrinsic or basically the essential elements of the soybean that lead to improved animal performance in our major buyer markets. And that's really something that we're going to be, I think, doubling down on in terms of international marketing efforts, because we know we need to move the meal in volume terms, but it's not just simply price competitiveness that's going to do it. We really have to be demonstrating and continuing to demonstrate superior animal performance when using U.S. soy meal. So it's really about showcasing the value and then moving the volume through showcasing that value.
Thank you, Mac. And thank you, Rob. We have a couple of questions that have come on in. I'll pose them to you, Mac. And the first question here is kind of a two-part one from April. So April, you touched a little bit earlier, Mac, on China in terms of their hog production, African swine fever, and really what their purchasing of U.S. soy has been doing here over the last year or two. April is curious as to when will they really start leaning into that Brazilian crop that you mentioned that will be coming online, particularly in January, as it has historically, perhaps even a bit earlier, given the really good start to their planting season. And then also April was curious on how inflation may affect the commodity markets here moving forward.
Sure. No, great questions, April. I knew I'd get some great ones from you. So I think starting with the China piece here, China is it's a buyer that does look for price competitiveness, and I'd say one of the headwinds that we have as an exporter this coming year, particularly relative to Brazil, is a very, very weak currency in Brazil. I think right now the real is trading about 5.6 to the dollar. This time last year, I think it was about 5.2. And Brazilian selling is not at nearly the aggressive pace it was last year. So it's held back relative to last year. So Brazil still has an ample amount of beans to market, and China might be adopting a bit of a wait and see approach. In terms of cutting into our export window, everything that I've been reading and seeing and following, indicates that Brazil is more likely to have kind of that regular seasonal pattern where January kicks things off, where we're unlikely to see a substantial erosion of our share in December by virtue of Brazil, getting in earlier. I mean, it's 86% planted right now, and that's this time last year, even with the slow start, they were at 81% at this point in time. So I think it'll probably be more of a normal piece rather than seeing Brazil start to eat into our export window on Christmas or earlier than that. So I feel pretty good about that and our ability to continue to move. The question is overall willingness to buy. China's certainly an overall pretty opaque market. The best I can go off of right now is say, okay, like crush margins are probably improving as the country implements a number of structural changes around its hog and pork production. I think these are welcome developments for anybody involved in the value chain that helps feed into that, because in 2018, I'd say the veterinary protocols and the sanitary protocols that China had were not nearly sufficient, and it really set a stage that was absolutely ripe for an infestation like we've seen with ASF. You had lots of swill feeding. That's since been banned by China, which of course also leads to more modernization of feeding practices, which in turn leads to soy meal having higher inclusion rates domestically. Those are all positive developments, independent of where they're sourcing, but because that's a bigger pile, or excuse me, a bigger draw, and part of that is going to be filled by U.S. origin soy. But it's also, I think operational things like zoning off centers of production and saying you can't move animals from one region to another because it's the transportation of live animals that has led to a lot of that has led to the spread of ASF. So the zoning pieces, and then there's just the physical infrastructure investment where you have these hog hotels, which maybe you see in trade circulars here and there, these 28-story facilities, which are really, round the clock monitoring, veterinary drugs closed off onto themselves, that are all geared towards, I think maximum hog efficiency. There's one other point I wanted to make on that. So I think you put all that together, and China's better insulated against a subsequent outbreak. And we saw outbreaks earlier this year. I mentioned the veterinary drugs earlier that might have not been efficacious, and probably led to a false sense of security. And so we saw some pockets of outbreak and everything, but it's not had the same terrible and widespread effect that we saw in 2018. So I think they're building a more resilient system there, which I think is structurally overall good. The second question, in terms of overall inflation on commodity markets, sometimes I think of it as a bit of a chicken and egg thing, right? Because the components of inflation are going to be comprised of prices for agricultural commodities, prices for foodstuffs. Certainly in the structurally low interest rate environment that we've been in for a very, very long time, and the perception out of the Fed that this inflation is transitory. That's my personal view. I don't necessarily agree with that. Prices tend to tend to be sticky, and inflation does tend to get momentum. You know, all of that together, I think where we are right now, some of that is going to be very positive for commodity price, because of course commodity price levels, be it ag commodities, be it metals, be it energy, you know, it's inversely related to the strength of the dollar, because these are all dollar denominated commodities. And you know, the dollar, I think, will remain relatively strong relative to its basket of trading partners, as long as there's not intervention by the Fed to, you know, kind of slow things down, ratchet up interest rates. I think that as you know, each month in mid-December, we're going to get another month of data out of the Bureau of Labor Statistics. Shout out there, I worked there for 7 years in inflation. You know, as we get the next round of consumer price data, as well as producer level price data, so basically those two stages of processing, that might create, I think, additional incentive when the Fed goes into its next round of meetings towards, you know, potentially, putting in some program for raising back interest rates. But of course, they're balancing I think the difficulty of not wanting to curb, you know, lending and any sort of, you know, lubrication in the system for, you know, people being able to afford things as we're coming out of COVID. You know, those credit markets really matter a lot, and I don't think the Fed is you know, really wanting to ratchet that up too much right now and disturb things. But where we are with inflation, we probably need to see something enacted here. It's just my view is from a market standpoint.
So Matt, we have about 8 minutes remaining here in our conversation this morning. I'd like to bring in a question from Michaela McGill. Michaela has been job shadowing several Iowa Soybean Association communication staff members. She's also a student at Iowa State University, also past president of the Iowa FFA Association. So Michaela would like to know, how do you see input prices and markets fluctuating as we continue to experience these supply chain issues and challenges? Do you expect those supply chain issues to stick around for a bit? And if so, how may that continue to affect the price of input, supplies that farmers need, and also the soybean market?
Wow, that's a fantastic question, Michaela. And you know, I think that really is the $1 million question here, right? It's hard to see. I wish I had a more optimistic view on this, but right now, I mean, we look at the supply chain challenges globally, and there's a couple factors that flow into there. You know, one, you know, global container shortage and container markets is really, you know, problematic. You know, certainly being able to, you know, secure goods and shipments coming in from overseas markets is tight, just due to the freight rates being, you know, really imbalanced. You have the labor shortage as well. You're seeing that, and I think that's a critical factor going back to the inflation discussion too. You know, sometimes it's not necessarily the raw materials that are getting more expensive, it's the shortage of labor for processing it, you know, into, you know, value-added products too, that leads to higher inflation in, I think, the end market retail level measurement. But it's, you know, as far as alleviation of all that, I mean, things probably have to get fixed, I think, on the labor side for us to see some of that debottlenecking that will allow for at least the pace of input cost inflation to abate somewhat. In terms of inputs here, unfortunately, it's my view, I think some of these higher fertility costs are probably going to be here for a couple seasons. And the reason I think that is for, you know, the raw material producers, again, you know, Russia and China, Morocco to a lesser extent, you know, is a major potash producer, but certainly Russia and China. I think as the world is coming out of COVID at various degrees, there's increased emphasis on, you know, national security and ensuring that, you know, the input, be it an input, raw commodity, whatever you produce, if you're producing in that country, there's somewhat more of a desire to hold it back to make sure that your, you know, your consumer base domestically is kind of getting that first order of seniority. And that's what gives me, I think, a lot of pause around, fertilizer and saying any of that's going to abate anytime soon. I think as you have, China and Russia kind of adopting these more nationalistic stances and holding back from international markets, that's going to be, I think, probably the most important sticking point here. And then on energy, again, going back to the inflation question, if we see some movement where, we get to a point where we at least have, a half point, whatever increase on interest rates, we probably see energy prices start to fall then, and that is going to lead to some abatement, obviously abatement on fuel costs, but I think to a lesser degree on fertilizer as well, but not the fundamentals of fertilizer. I think are in terms of like availability are still going to matter a lot more than what's happening in the financial markets to help dictate it. But great questions, Michaela.
So we have two questions here to go, Mac, and one ties in with a conversation I had yesterday with an Ames, Iowa-based company that really specializes in producing soy-based products, whether it be for roof applications, whether it be for asphalt and concrete, to extend the life expectancy. The name of the company is Color Biotics, and I think Chuck White's question that he posed here this morning feeds right into that. They're really looking for and preferring hyoleic as a oil product to use in their products. So Chuck is wondering, what do you see as the demand here moving forward for hyoleic? Where do you see that market proceeding?
No, great question. And you cut out a little bit for there because, I'm at my parents' house. They don't have the greatest Wi-Fi. But I think I got the general tenor of it. Hyoleic, I think it continues to be a program we're very excited about. And certainly we've seen ample end user demand that is calling for more acres. We've got a number certainly have been contracted in parts of the Delmarva and other parts of the country. We want to continue to see acreage expansion in hyoleic. Anything that we can do that enables a premium to accrue back to our farmers is critical. Now, sometimes the incentive for planting hyoleic isn't necessarily as strong, even with the premium, when commodity beans are trading for $12.50 or higher, and those segregation costs aren't necessarily desirable to take on. That's a farmer decision. Everybody gets has a chance there. What's harder is ensuring that we get the volume of seed stock from the trait provider, so that it can be placed into the marketplace. We're getting the signals from end users, certainly from the food space, as you mentioned as well, in the industrial space. So I think much like, actually, in an interesting parallel to the renewable diesel place, that demand is there. It's the end user demand that is being built. And I'll use the Field of Dreams analogy. If you build it, they will come. Well, hopefully those signals are flowing back up, and I feel like that's incumbent on us as state and national checkoff organizations to be signaling, yeah, there's those demand in the end market for increased hyoleic. Let's get it, let's get the commitment to cultivate it, and most importantly, let's get the commitment for the feedstock that you actually need for these value-added traits. So it's a central part of our program. We're excited about it. We think more higher value opportunities, and hyoleic is just one example of them. We really see that as the next wave and for delivering increased value back to farmers on a national basis.
We have one last question, and then I'll turn it back over to Rob to wrap things up here, Mac. But Kirk would like to know, so this question comes from Kirk Leeds. He'd like to know, with the growth in demand for soybean oil and renewable diesel, will we see most of that new demand simply a displacement of existing soybean oil demand for biodiesel? In longer term, will the projected growth in demand for soybean oil for renewable diesel force a rationing of utilization in food use?
Great question, Kirk. Longer term, well, I guess short term, so let's think about the traditional biodiesel and the renewable diesel paradigm here, right? And I think a lot of this is a question for NBB, National Biodiesel Board, but there's also Clean Fuels Alliance for America at this point. And their view is that there can be coexistence between legacy fatty acid, methyl ester plants, renewable diesel, sustainable aviation fuel. Like as we think about, feedstocks that flow in, be it from soybean oil, be it from tallow, canola is going to get an approved pathway for renewable diesel in the next couple of years. You put all this together, hopefully that provides some collective alleviation of overall feedstock shortages. But, I think some of this is also predicated on the credit levels that various energy producers are able to get based off their production practices. And there probably will be instances where legacy FAME refiners, some probably get priced out a little bit due to some of that credit structure. And I obviously don't get to play in that space, and frankly, nor would I really want to from a policy and advocacy standpoint. But that'll, I think, be a real thing to consider. Longer term, in terms of rationing, food, versus fuel in the oil space. If I'm looking at the USDA balance sheets, and these only look 1 year into the future right now, but if I think back to when the first marketing year 21-22 balance sheets were put out back in May, there was a really significant expansion of the expectation of how much oil would flow into bioenergy. It was taking it up, I think, from 8.5 billion pounds to 12 billion pounds, which is a pretty substantial increase year on year. But that, I think, was a bit of an overshoot, and you've actually seen the revisions in the balance sheet since then, and now it's taken down to 11 billion pounds, which is still a pretty substantial increase. But it's primarily been taken out of those export channels. But you've also got the increased production to offset it somewhat. In the years to come, what I don't want us to get into an environment of is where, much like with China, we've put too many eggs in one basket and we're not looking at our other uses. I want us to make sure that we still have a strong foothold in the food space, and it's not just all looking at this next bright shiny thing. And I think that fortunately or unfortunately, we have a good legacy historical example to look at. And many of you lived through this, 15 years ago, when we had the ethanol build out in the US. That was fantastic for 5 years, building it up to be an over 5 billion bushel market, 15 billion gallons thereabout. That was really, I think, great. We had a run of very, very strong years on the corn side and corn profitability, a pretty substantial wealth build, particularly in those like 2010 through 2012 window. But it's not been a growth market in the last 10 years since then. And I think we could see something similar in the renewable diesel space, where we have this pretty ample build out, maybe even as long to the end of this decade. But I don't want to think that is the only engine that's going to carry us going forward. So I think ensuring that we continue to underscore the versatility of the soybean and the products produced from it, ensuring that we maintain a strong foothold in the food space and not let that get displaced by palm or sunflower or something, obviously dependent on cost, dependent on volume. I want to make sure that we're channeling into as many diverse applications as possible, because one day, even though it might be a structurally higher market in volume terms, if it's not a growth runway anymore, that value premium might not be there as well. So we need to continue to think about diversification. And of course, I've said this a lot in the past couple of weeks in various interviews. We need to focus on our strength. And we're an oil seed notionally, but we're a protein seed. The oil seeds are 50-50 oil and protein, more or less. You look at the soft seeds, and we're 80-20. So we can't forget what our fundamental strength is and what our fundamental strong markets are, and that's of course animal ag. But fortunately, we've got a good disappearance channel for that in Iowa, and that's just where it starts.
Great, Mac. Thank you. And I think we'll have to leave the questions there. So Rob, I will turn it over to you to close today's webinar.
Well, Mac, thanks. Appreciate it. Hopefully everybody got a little something out that they can take back and put into those marketing plans that we know is important. It's quite a we got a lot of stuff changing right now in this industry, and you can never have too much information, I think, and the way it was brought to us today. It was easy to understand, I think, and I appreciate Mac taking the time, and again, to those of our members out there listening, that this is some of the checkoff dollars getting spent, and the research that's being done, and greatly appreciate everybody taking the time this morning, and I guess we'll wish everybody a happy Thanksgiving, and we'll wait to see you next time at the next meeting, I guess.
Well, thanks everyone for the opportunity today. I really appreciated the questions. Hope you enjoyed the program. Please shoot feedback back to Aaron and Iowa Soy, because again, we're just kind of piloting this, pioneering it. So hopefully it was beneficial, and hopefully we have a chance to do it again, because it was beneficial. But in any event, thanks again, and everybody have a wonderful Thanksgiving. If you're traveling, stay safe. Heck, if you're home, stay safe. And yeah, happy Thanksgiving, everyone.